let's talk about what it takes to form an opinion using this audit evidence. Now, in forming the audit opinion, the auditor does not examine all the information available. You don't examine all the evidence because conclusions can ordinarily be reached using sampling. We're not going to examine every single invoice. We're not going to examine every single purchase order, every single bank statement. Well, bank statements maybe it's different because it's cash, right? Cash is pretty important. But we are not going to examine every single piece of evidence because we're going to sample. We're going to sample parts of the population and get evidence and assess evidence just for those selections. Now, might think, why don't we just do everything, right? Like if it's easy enough as just dragging down a formula in Excel to assess everything, why don't we do that? Well, if you add audit evidence to your audit file, that essentially means you considered it. If you consider more evidence and there actually turns out to be something wrong with it and there was some error or fraud in that evidence, you're essentially taking responsibility for it. So the whole sampling is just as much for efficiency and not having to test absolutely everything as it is for limiting your responsibility. Because if you say you tested every single transaction for a client, and maybe it was easy enough to do that, right? Maybe it was easy enough and you just did that. But let's just say one transaction was very fraudulent. You've now just said you've assessed that, right? And you've taken responsibility for it. And there's no way you're going to be able to give the time of day to absolutely every single transaction that you're taking responsibility for. Also, the auditor may find it necessary to rely on audit evidence that is persuasive rather than conclusive. However, to obtain reasonable assurance, the auditor must not be satisfied with audit evidence that is less than persuasive. Do not be persuaded by that audit evidence. Don't let it sway your mind. Make sure that you are assessing audit evidence that is actually helping you to reach a conclusion. The auditor should use professional judgment and should exercise professional skepticism in evaluating the quantity and quality of audit evidence and thus its sufficiency and appropriateness to support the opinion. We want to make sure that we question everything. We have that questioning mind through professional skepticism, and we are actually taking a step back and utilizing our expertise and our experience to make sure, is there anything strange about this document that we got, right? Is it weird that we received it from person A instead of person B? That's something that we want to consider there. Management assertions. Management is responsible for the fair presentation of financial statements that reflect the nature and operations of the entity, and in representing that the financial statements are fairly presented in conformity with GAAP, management implicitly or explicitly makes assertions regarding the recognition, measurement, presentation, and disclosure of information in the financial statements and their related disclosures. We're going to see these assertions. They are kind of difficult, so if you don't have them down at this point, I would make sure to start memorizing them and understanding the differences. Here we start to see occurrence, completeness, accuracy, existence, cutoff, valuation, rights and obligations, right? All of these. We've got categories of assertions. And just to kind of give you a preview what we're going to look at, we've got 1, 2, 3. We've got assertions that have to do with classes of transactions and events. Assertions that have to do with account balances. So this is transactions and events, usually more associated with the income statement. Here are going to be about account balances, which is generally more the balance sheet. And lastly here, presentation and disclosure, the notes of the financial statements. Let's go back to our first one here. Assertions about classes of transactions and events for the period under audit. These are the assertions, so I would definitely memorize that these are the assertions having to do with transactions and events, and then obviously memorize the following slides as well. And also, you want to make sure you understand the differences between these, and why I said it's difficult. Sometimes it's difficult to understand the difference between, let's say, occurrence and existence. Like, did something occur or did it exist? They're actually very different. This will help you to distinguish that and earn you free points in the exam. Now, occurrence and existence, you might think, are very similar, but existence, we're going to see, is actually more related to our balances, whereas occurrence is more related to transactions and events. So transactions and events, did the sales, did the expenses, did the purchases actually happen? Had they actually occurred? The ones that have been recorded, did they actually happen? And did they actually pertain to the entity? Completeness, all transactions and events that should have been recorded have been recorded. And these assertions, these are essentially implicitly or explicitly stated from management, saying that everything that occurred is listed. Everything's complete. Everything's accurate. There's no cutoff issues. Everything's properly classified. Your job as an auditor is to make sure that all of these are true. And how do you do that? You do that through testing, through substantive procedures, and going through our business cycles, which we'll see in that lesson as well. Accuracy, amounts, and other data relating to recorded transactions and events have been recorded appropriately. Cutoff transactions and events have been recorded in the correct accounting period. Important one there. And lastly, classification, transactions and events have been recorded in the proper accounts. Did we improperly classify something as a note payable when it should have been an accounts payable? Did we accidentally include a sale next year instead of when it should have been this year? Is everything accurate? Are the actual dollar amounts accurate, right? Making sure that we're understanding these. You can see sims, you can see multiple choice questions. Super important points to know. Now we see the account balance ones. So you might say, hey, I'm seeing the sim, Nick. How do I know the difference between existence and occurrence? Well, we see that existence has more to do with assets, liabilities, and equity. It has more to do with actually doing an inventory count, doing a walkthrough of their factory to see if they actually have the equipment that they say they do. Existence, do all of these exist? Do all of the cash accounts exist they say they do, right? Do the ownership, equity interests, the investments actually exist? Rights and obligations, the entity actually holds or controls the rights to the assets, and liabilities are obligations of the entity. Want to make sure that we are properly listing all of these. Completeness, all assets, liabilities, and equity interests that should have been recorded have actually been recorded. Valuation and allocation, so assets, liabilities, and equity interests are included in the financial statements at appropriate amounts, and at any resulting valuation or allocating adjustments are appropriately recorded. Making sure we memorize that these have to do with the balance sheet, and these are what the auditor are going to be performing procedures in order to verify. You want to make sure that all of these are true, that there's no issues with any of these points with the financial statements. Lastly, we would get to assertions about presentation and disclosure. We've got occurrence and rights and obligations. Now you can see, right, some of these are duplicates. You see that, okay, well, didn't we see occurrence before? Yeah, we did, but we're going to see it again. So memorizing that occurrence and some of these other ones also applies to presentation and disclosure. So occurrence and rights and obligations disclose events and transactions have occurred and actually pertain to the entity. We want to make sure that the notes to the financial statements are complete, that all disclosures are actually included in the notes, all going concern issues, all litigation, all disclosures that should have been included have actually been included. We've got classification and understandability. Financial information is appropriately presented and described, and disclosures are clearly expressed. Right? Can an average user of the financial statements actually understand what the heck is going on there? Lastly, here, accuracy and valuation. Financial and other information are disclosed fairly and at appropriate amounts. How is the auditor going to use these assertions? Well, the auditor may use the relevant assertions as they're described above, or may express them differently provided aspects described above have been covered. But what are we talking about here? For example, the auditor may choose to combine the assertions about transactions and events with the assertions about account balances. As another example, there may not be a separate assertion related to cutoff of transactions and events when the occurrence and completeness assertions include appropriate consideration of recording transactions in the correct period. All this is saying here, when we have these assertions, you don't necessarily need to treat it all as a checkbox. You could have procedures that cover multiple of these, right? Some of them may not even be relevant to the entity. All we're saying is use your professional judgment, and the auditor can combine, separate them out, maybe even make new assertions, right? It's up to you as the auditor to use your professional judgment and conduct an appropriate audit. The auditor should use relevant assertions for classes of transactions, account balances, and presentation and disclosures in sufficient detail to form a basis for the assessment of risk on the material statement and the design and performance of further audit procedures. The auditor should use relevant assertions in assessing risks by considering the different types of potential misstatements that may occur, and then designing further audit procedures that are responsive to the assessed risks. The auditor is going to be doing substantive testing, tests of details, confirmations, walkthroughs, doing these tests in relation to each assertion. Just to repeat that again, the auditor, for every testing action they take, you can tie that test to a particular assertion. And again, like I said, it could be in sims, it could be multiple choice questions. Get familiar with these. We're going to see them a lot. Relevant assertions are assertions that have a meaningful bearing on whether the account is fairly stated. For example, valuation may not be relevant to the cash account unless currency translation is involved, because let's think about that for a second. Cash is cash. $1 equals $1. We're worried about existence and completeness. Does the cash actually exist? And is it a complete amount? Are we excluding any cash? But the thing is, we're not worried about valuation. Like, if we verify that the $10 of cash exists and that it's complete, well, $10 is $10. It's not, we're not worried about that. However, let's say the client has a bunch of stocks, a bunch of investments. Are those securities valued at their proper amount? That's where we'd be concerned about valuation. Similarly, valuation may not be relevant to the gross amount of accounts receivable balance, but it is relevant to the related allowance accounts. Valuation it might not be relevant to just what you are owed, but it might be important to this allowance for doubtful accounts balance. Additionally, the auditor might, in certain circumstances, focus on the presentation and disclosure assertion separately in connection with the period and financial reporting process. In reality, all right, what we're seeing here, you can customize it, you can do it as you will, but we're generally going to follow this basis. We're generally going to have each assertion broken out, have certain testing procedures assigned to each one. That's just how it's going to be, especially textbook accounting for the AICPA for the exam. Identifying those assertions. So for each significant class of transactions, account balance, and presentation and disclosure, the auditor should determine the relevance of each of the assertions. As I mentioned, they might not all be relevant, and they're not all going to be relevant for every account or every type of transaction. It also depends on the entity type, right? An entity may just not have a lot of cash on it. Now, generally, entities do have cash. That's just, businesses should have cash in hand. But let's just say you're auditing a company and they don't have inventory. Well, obviously, any assertions related to inventory are just not going to be relevant. If it's a software company, you're not worried about that. To identify relevant assertions, the auditor should determine the source of likely potential misstatements in each significant class of transactions, account balance, and presentation and disclosure. In determining whether a particular assertion is relevant to a significant account balance or disclosure, so in assessing and determining whether this assertion, whether its existence, valuation, accuracy, is relevant to cash, investments, accounts receivable, the auditor should evaluate the nature of the assertion, the volume of transactions or data related to it, is it material, and lastly, the nature and complexity of the systems, including the use of IT, by which the entity processes and controls information supporting the assertion. Having a good time here, really diving deep into these assertions, and as I mentioned, you can see these much more in depth in how we're actually going to follow through with testing them when you get to the revenue cycle, cash cycle, inventory cycle, that lesson there. So if you ever wanted to kind of jump around and check that out, feel free, but you will see that as well.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.